Thank you for joining me. I'm Alex, and I would like to talk about Lufthansa. So they've had a pretty rough day on Friday, and so I figured might be time to look into that a little bit. So what they do is they're not just one airline. They actually are several airlines, including Austrian Air, Swiss, many others. They also do a large portion of freight. So they're doing all things air related. So current price is $17.42, which gives them a market cap of $8.3 billion. The current dividend is just under 5% with a 28% payout ratio, which is amazing. Current revenue 35.8%, $35.8 billion, which is up 1%-ish. Earnings $2.1 billion, which is down slightly, 10%. It's not slightly, I guess, but that gives them PE of 4, or just under 4, which is amazing. So total assets $38.2 billion, total liabilities $28.6 billion, which gives them a total stockholders' equity of $9.4 billion. And even though I say dollars, it's all in euro, and I'm too lazy to do the conversion because it's all just 10% higher. So the numbers all still make sense, and a 5% dividend yield with a 28% payout ratio is just unheard of. And a PE of 4 is not really unheard of because I think Macy's was there when I did that analysis. But Lufthansa is a fairly stable company, and they've been around since the 50s. They started business in 1955, and obviously very stable. And I don't think that the demand for air travel and air freight is going to go down in the near future. Obviously, things happened to the oil price recently, which had an influence in airline stocks, because they obviously need to either raise prices or lose profits. And that's not an easy choice to make. And you kind of have to weigh options because the oil price is never stable. And so you kind of wonder what the threshold is for raising prices and what the threshold is for just, eating into your own profits. So obviously, oil price going up hurts airlines a lot. But with a PE of 4, you think that the oil price can rise quite significantly without hurting them significantly. So I would say that the oil price rising really isn't that big of a deal for a company like this, which has a PE of 4 and a payout ratio of 28%. So overall, I would say that obviously if you're looking for a growth stock, this is not it. But if you're looking for a value stock, the balance sheet is not great. I will admit that, but it's not terrible. It's stable. Even the equity is going in the wrong direction, but it's just ever so slightly going in the wrong direction. It's less than 1%. But it's not great, but it's not terrible. There's quite a bit of equity there. There's enough to weather out a recession. And so I would say that even for a value investor, especially with a PE of under 4, I think that there isn't really a whole lot that would justify passing up the stock. And for a dividend investor, a dividend yield of just under 5%, or basically 5%, is amazing, and a 28% payout ratio is amazing. So that's going to be hard to pass up as well. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.